All right, good afternoon, everybody. Today is Thursday, March 9th. And I am an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member if and recipic. All of my trades are placed through T3 Trading Group, and you should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure. I got a little bit of Roku, which is helping offset my PDD short, which that short's much heavier. Sorry, not Roku, JD. I do also have a very little bit of Roku that I got back into because I got to my buy back in area, like I was talking about in yesterday's afternoon meeting. And same thing with Snap, got back into a little bit of Snap. Oh boy, I'm tired. I'm like a little worn out from today. It was one of those days, kind of a stressful trading session. Yeah, SIVB, right? Silicon Valley Bank Group or whatever, off 61% here, closing out just above $100. That's the story of the day. Let's go over that in a minute, though. Let's talk about this market real quick. Our consistent canary in the coal mine is this IWM. I don't even know why I should look at the SPYs and the Qs. The IWM's been a problem here for days. It tends to lead the market. I've been saying since the 6th here that the relative strength in these mega cap tech stocks, starting with that Apple upgrade from Goldman, has been masking the weakness in this market, but you've been able to see the weakness in the market in this IWM. IWM yesterday was breaking that major support zone, but managed to close above it. And then today, especially if you're looking in hindsight, that 186 didn't even stand a chance. And then as a result, you had these other indices break down much further. The SPYs here really broke this important 393 to 394 support that we had been looking at, worked its way down almost to 290. And the Qs are actually still intact. Where that relative strength has been with those mega cap stocks, it is still intact. It is still in its range. But make no mistake about it, the market looks terrible, and we're starting to get into those points on heavier market sell-offs where we really begin to look at degrees of market extension to potentially come in on the other side. You know, we've consistently seen that $10 to $15 of extension on the downside and the upside has been a great spot to potentially come in counter trend. And when you're decently extended but not that extended, a lot of times you're kind of a little bit in no man's land where the risk reward is, in this case, is no longer great to continue to short. Like if we gap down to 390 tomorrow, which is basically today's low as an example, I think that risk reward is really no good to short outside of very small time frame momentum style trades. But yet you're not quite at 390 at the spot, where you're at that $10 of extension where you can start to be a little bit more aggressive on the counter trend side of things and think that you can be able to build in. But make no mistake about it, today is a really bad day for bulls. The picture began to change a couple days ago, but we were in neutral territory coming into today. And not only were we in neutral territory, but we were setting a gap up and we're above, SPY 400. This almost seems like a whole different trading session this morning when I was talking about, well, if we can get above 400, I bet we get a move to 401.50. And high of the day, that's exactly what I said in the morning meeting. High of the day is, am I echoing on YouTube? I bet I am. I just fixed it. I was going to make that one change. High of the day is 401.48. So, yeah, I mean, that call was pretty perfect, not because I was looking into Josh's magical orb that tells the future, but it was just an appropriate measured move on a day higher, and again, obviously the entire market changed with this SVB regional bank kind of blow up, but the expectations on today were, if we're above, yesterday was a rest day in no man's land, right? Yesterday was a rest day in neutral territory. Tomorrow we've got non-farm payrolls. Tuesday next week we got CPI. My thought process is really that the market generally wants to wait for those numbers. And if they come in hot, we could see a pretty heavy sell-off. And the plan was kind of working out. And then I think I also said, you know, we could get a little bit of an upside move above yesterday's high, a little bit of a downside move, a little bit further follow through below yesterday's low. And again, off the open, we got that exact bounce that we were looking for to the exact spot that we thought was reasonable. I did not think that we'd be able to negate the Jerome Powell sell-off day by any means today, but it bounced back to where, you know, the 21 EMA on the daily chart was at that time, to that 401.50 or so. Makes sense if we're above yesterday's high or above 400 that they squeeze shorts a little bit. And it's kind of what happened. And it was really led by, again, the Qs and led by these mega cap stocks. Apple was trading great this morning. Amazon was trading phenomenally well this morning. Microsoft, massive leader. I mean, it's all you need is those three companies being really strong, and it makes the entire market look decent. You know, maybe Google was a little bit weaker, but still not bad. Meta, you know, sold off pretty hard. At one point, I thought this was like the worst one that was out there, but it's been great on the daily chart and is kind of getting up into big resistance. So that's the original thought process, but underlying all of it was this IWM weakness again, and we've just seen it so often. This IWM weakness leads to sell-off and everything else. Look at 9:55 a.m. this morning when the Russell's breaking new lows compared to what the Qs are doing at 9:55 a.m. this morning, making new highs pretty much. You know, SPYs were kind of trying to hold in. They made this little bit of a lower high. At this time of the day, and when I was getting off the radio at like 10:45, I was like, okay, we're just going to chop around the rest of the day, most likely. You know, IWM weakness is notable. It's concerning. We're below 186. I don't like that. But non-farm payrolls tomorrow. Look what the SPYs are doing right now. We'll probably just end up chopping the rest of the day. That was inaccurate. Eventually, the IWM got to the rest of the market. And the reason why that IWM was leading lower and eventually got to the rest of the market was because of this SIVB. Just really, really nasty here. Certainly saw the gap down this morning. Looked at it a little bit. A few of you guys provided information on it pre-market, which is always really appreciated. I guess I underestimated the power of this thing here this morning, just because I'm like, all right, you know, regional bank in some trouble. You know what? SI is also in some trouble and is going to go bankrupt, but I don't necessarily see SI going bankrupt as, you know, leading to contagion for the rest of the market. But this SIVB really started to pick up some steam here. Oh my God, it's brutal. And it was really wrecking this KRE. Even XLF was getting hit really hard as well. XLF ended the day down just over 4%. You have like, you can look at like that PACW that Josh mentioned, PACW here. PacWest Bancorp down 25%. So the real question, I guess, that we're trying to figure out is this a contagion situation or not? And a lot of times when the market's not sure about those things, it's sell first and ask questions later. Just get the risk off the table. And I don't know. I really don't know what this is going to turn into. So I still have to do a little bit more research on exactly what the news was. You guys probably know it better than I do. But basically, they had to sell at a really big loss some of their holdings that they have, some of the assets that they have. I still got this pack up. I should put the other one up. At like a really solid like $1 billion plus loss, it sounds like. At the same time, they're trying to do like a $1 billion plus capital raise through a secondary offering of equity. Sounds like somebody's already put $500 million into it. A lot of this is coming from a result of what the Fed is doing with interest rates, and as a result of the yield curve inversion that we're kind of dealing with. So the real question that you want to ask yourself is that loss that SIVB took on some of their paper today, which is a really big loss. Is that something that is specific to this company, or is that something that all these banks are potentially going through, all these regionals are going through, and potentially even the majors are going through? And yeah, I don't know the answer to that. I haven't done enough research, and I would certainly be a little bit concerned that somebody knows something when you see this PACW down 25% as well. My initial thought process, without having done more research, is that this will be somewhat contained. And the reason why I think that is just because of the rules and regulations that at this point have been imposed on the major banks. So, we don't want any of these banks going under. It's definitely a problem. But it's one thing to see a regional with a relatively smaller market cap. I don't know what it was coming into today. Let's just call it $10 billion. And I say relatively smaller because I think Bank of America's got like a $250 billion market cap. So it's a really big difference there. It's one thing if we lose a regional or two, which again certainly isn't great. It's something else if there is similar issues that can arise at these major banks. And my initial thought process is that they're just too well capitalized. They are required from Dodd-Frank and everything else to just hold so much cash reserves that I think they should be able to weather pretty much any storm at this point. But we'll see. I gotta do more research on it. One thing is for sure, there's been chatter for at least a year now about how the Fed's going to continue to raise interest rates until they break something. And if anything, the impressive part about this is that they've been able to raise interest rates so far so fast without really breaking anything outside of popping a bubble in growth stocks that we had. So maybe this is finally a thing here where the Fed has to look at what they're doing and say, wow, we might actually break something here in the system. And slow down a little bit. So we'll see how all that plays out. And again, I certainly have to do a little bit more research. I'm sure that there is going to be a Lenkov telling us before today the market cap was 15.8 billion. After today, it's 6.3 billion. And again, a $16 billion bank, going through these types of problems, maybe even goes bankrupt. I have no idea. Is certainly a big problem. But that's relatively small when you're looking at the market cap of Bank of America or the other majors, which I think Bank of America is around $250 billion, but someone can fact check me on that. So we'll see. Another thing that we need to keep in mind though as we see this breakdown is that markets work in feedback cycles. So maybe this SIVB is just the thing that got the market going to the downside. He said 248 billion, not bad. For Bank of America. So markets work in feedback cycles. So this SIVB is what really broke the market down today. But we're below major support now. We're extended, but we're below major support. So selling leads to selling in the marketplace. Markets work in feedback cycles. It's one of my key themes of understanding how markets work. So you get below support, you get below the 200-day, you have the volatility increase, all of that potentially leads to more systematic selling that comes into the marketplace. Trend following algorithms and traders start to get stopped out. That leads to more selling in the marketplace. And you can get a downtrend wave that comes in off of that. And this is potentially very damning to these bigger picture bulls out there that are looking for this to be a high, a higher low, a higher high, and then they really wanted this March 2nd to be the next higher high on this big picture. So John Lee saying the major banks have trading desks with bigger books than the market cap of SIVB. Absolutely. So we will we'll see how this plays out, and then this is all in front of non-farm payrolls, and then in front of CPI. And Pat was posing some interesting thought processes that a hot non-farm payroll number could really get us into the depths of that bigger degree of extension that some of us have been looking for as we've been trading through this chop over the course of the last few weeks here. That could lead to a lot more opportunity again from a market perspective. These last few weeks we've had to really focus on the individual stocks that are out there that are in play because the market itself, yesterday I genuinely felt like it was a coin toss from the moment the market opened on which way the market itself went. This morning the coin toss, wasn't too much more weighted on one side. So we'll see. This could really start to open up some real market moving opportunities again that we haven't really seen here in a few weeks. I think that's pretty much all I've got from the big picture. on a small picture, you know, some decent stuff off the open that we were looking at that I don't even know how these things closed. We were looking at Paysafe for a long off the open. I was really eyeing this one at the open, but thought the spread was too wide, so I didn't get in. Fuel Cell was one that we discussed for like a short squeeze, like versus 350. I don't know if you guys caught that. It was a decent opening drive trade. Again, most of these kind of failed eventually because of the market. General Electric was one we were looking at, but I felt it gapped up a little bit too big. If anybody was willing to pay up, that one worked out pretty well. And then we were just looking at, you know, the relative strength in some of those mega cap stocks. I remember, you know, Pat kind of debating with Chris during the morning about, you know, getting rid of their entire Amazon position at 95, even though it could go to 96. Those are obviously really good problems to have, and it was a great call there. Only other thing I wanted to bring up on this intraday chart, now that I'm remembering, is just this little capitulatory move at the bottom, just so traders learn to pay attention to this, where these, you know, you get this type of a move with this type of speed. This is a capitulatory buy setup. We haven't really seen too many of these in a while, and despite the fact that we've been in a bear market, there's actually been very few of these over the course of the last calendar year. But when you just get this, I'm not going to count it, eight red 5-minute bars in a row, volume increases, maximizes here at, you know, 320 with a lot of extension. That's usually a pretty high probability retracement spot, retracement back to equilibrium. And if you're able to get some good stock at a decent price, it's big. You know, for myself, I was in this TQQQ. I think I was able to buy $21.69 versus lows. So I basically, you know, 10 cents worth of risk. 80 EMA is more than 10 cents above that. 21 EMA is well above that. So if I can just get this bounce in this equilibrium, which probably has a greater than 50% probability of happening when you get this type of capitulatory action with this degree of extension, that volume pickup, that's a trade that I really like. And again, still has a high probability of eventually failing, but also has a high probability of giving you at least that initial price correction higher that can pay you. And then sometimes if you can combine this type of action with our $10 plus of daily chart extension, then sometimes you can get some stock that could be really, really good. You could kind of catch a little bit of a real-time bottom for yourself. We didn't really have the daily chart extension. I wasn't stock that I was going to feel comfortable keeping overnight. With just a half hour left in the day, even if we had a bigger bounce in the close, I was gonna sell out that TQQQ position into the close. But if we were even more extended on our daily chart, if today was more of like a day 3 and we were $12, $13 extended from the 80 man on the daily chart, then I would have been looking to have a much greedier game plan on that TQQQ long into that capitulation and try to keep some overnight and see if I could nail myself more of a real, I don't know, I hate calling it bottom because picking bottoms is a great way to lose money, but let's just call it at least a bigger picture, bigger time frame retracement, which could pay you really well. You know, if I was doing that same trade and we were trading it, you know, 386 at that point, then that's a thing that I want to keep overnight because I could get a snapback to this 80 MA off that on the daily chart, which will be declining, but maybe that means I'm buying, you know, SPYs on a 5-minute chart or a TQQQ, trading it with the market for 10 cents worth of risk like that for very small risk, and be able to get the equivalent of a, you know, $9, $10 bounce in the SPYs through a price correction when everything is coming together right like that. The 5-minute capitulation in conjunction with that really big picture downside extension. But we aren't there yet. Today's day 1, not day 3. And we were pretty extended at that point, you know, at lows today. We're maybe $8 extended, something like that. But I really want that $10 plus to feel more confident on a bigger picture bounce. So I think that is all I got for you guys today. I'm beat. I don't know why. This day kind of wore me out. But I am happy to answer any questions that any of you guys have. SIVB still selling? Yep, $97 now. Whew. Alright, let me scroll up here into the virtual trading floor and see what you guys got for me. Alright, so Oracle reported. Seeing little Little beat there on Oracle. I'm not seeing guidance. Small beat on EPS, small miss on revenue. They're selling it off though. I don't see guidance. DocuSign is out. DocuSign's down a little bit off this report. I like this company on dips. I think it's a buyout candidate. It's one of those ones on my list. Looks like their guidance is kind of in line. Revenue guidance kind of in line. So I'm not really sure what's hitting that down. CFO is transitioning out of the company. We got Ulta. Ulta down but bouncing back a little bit. Okay, so that's just some stuff we can keep on the radar tomorrow morning. From DJ, when you sell at the market open almost instantaneously, do you have orders that specifically set to trigger off the open, or are you just using hotkeys? Just using hotkeys. I don't use MOO or MOC orders. From Kyle, one. I'm assuming that means there's going to be a question 2. Uber was on watch this morning, but the level never triggered, so I never took it. Perfect. That's what we want. Yeah, we had Uber on our list this morning. Uber was showing relative strength because they are, whatever, selling off one of their businesses or something like that. I don't remember exactly what price I called out in the morning meeting. Probably 34.50 or 35, something like that, as a spot to watch. Never triggered. You don't get involved. You don't lose money when the stock sells off. Was just curious what would have been the correct level to use. Looks like in the note I wrote 34.75. A lot of times on my note there, I'm kind of just approximating levels and rounding them out a little bit. Probably what was yesterday's high? Yeah, 34.63 is yesterday's high. 35. We always want our levels. Edward, if you're having problems with that, try the YouTube. We always want our levels to be perfect to the penny. Most of the time they're not. Most of the time the level is actually a range. It's a space between here and here that you want to pay attention to, and then you want to look at your small time frame as it's trading in that range, try to get an approximation of the right entry point. So again, I wrote into the VTF 34.75. I'm looking at a 15-minute chart from the last few days here. Maybe 34.60 actually would be even better. It's the space between like yesterday's high and $35. But you can see, if I'm looking at your 15-minute chart real quick, that the last 2 trading sessions, it was really creating some resistance intraday at 34.60. So I would see that and maybe use 34.60 as the actual jump-off point for a break. Question number 2. Also, could you explain ECN fees a little bit, and can they really eat into accounts, especially as a new trader with a smaller account? Sure, I'm happy to talk about ECN costs. Can they eat into a trader's account a little bit? I don't think it matters whether or not the size of the account on this. The answer is yes, but routing is really important, and it can also be your friend. For me, every month, I'm pretty sure every month, I get paid by the exchanges at the end of every month. At the end of basically every month. I don't remember when the last time was that it was the opposite. When I go back and I review my trading for that month, and I review things like that, which I usually actually don't look at costs, because costs just are what they are. But at the same time as I say that, I don't look at costs because I already know that I trade very efficiently. If I didn't know that already, or at times in the past when I was working on my trading efficiency, I probably would pay more attention to it and actually look at those numbers in a little bit more detail. But I can say with strong confidence that every single month for a long time now, probably maybe for years, at the end of a month, I am paid by the ECNs. They pay me more than I pay them. The way that exchanges and ECNs make money is through the maker-taker system. And this definitely applies to you if you have direct market access, which anyone who trades through T3 Trading Group has direct market access, which paying these costs, in my opinion, is still significantly better than using a broker that engages in payment for order flow. Yeah, the way that they make money is if you provide liquidity, they pay you. If you take liquidity, you pay them. But taking liquidity costs more than they pay for providing liquidity. So, like, just to make up some very simple numbers, like, and I don't remember what they are off the top of my head right now, but if you provided liquidity on 1,000 shares of stock, maybe they pay you $1.50. If you took liquidity on 1,000 shares of stock, you pay them $2. And on every single transaction, there's a person who provided liquidity and there's a person who took liquidity. So in every single transaction, the exchange makes the difference. That's how they make money. So I always try to provide liquidity whenever it is appropriate. And that's the key word. You don't want to be, I've made this mistake, don't make this mistake. You don't want to be being cheap by not wanting to pay a spread and not wanting to pay an ECN fee and not getting stopped out of a position that's failing for you. I remember, I like to use this example even though I don't remember the numbers. I remember trading UGAS, and this is such a stupid thing that I did, especially on an ETF like UGAS, which is no longer listed. But UGAS was like the 3x leverage nat gas ETF. Now we look at BOIL a lot. BOIL I think is 2x. I was trading UGAS, and the market was moving slow for it, but nat gas can start moving very quickly when it wants to. And I had a big position. I don't remember what my sizing was. I'm at 5,000 shares, 8,000 shares, something like that. And stock grinded down to where my stop loss was. And I said to myself, you know what? Instead of having my stop loss trigger and paying the spread and paying the exchange costs on this 5,000 share position, whatever it was, I'm just going to cancel this stop. I'm going to go inside offer. I'll get filled on the offer. I won't have to pay the spread, and I'll get rebated on the 5,000 shares instead of having to pay those exchange costs. Well, that was a terrible idea. That was a terrible idea because I didn't get filled on the offer, and the market woke up and started selling off a little bit more heavily. And instead of losing, I really don't remember what my risk on the trade was or exactly what my size was, but let's say instead of losing $750 in the trade, I ended up losing like $4,500 on the trade. All because I was trying to be cheap on exchange costs and, like not getting some slippage on the spread. Stupid. Oh man, was I mad at myself. Clearly I'm still mad at myself. And this, was obviously well over a year ago because UGAS has been delisted for a while. You don't want to do that. So if your trade is failing and your stop loss is triggering, you know what? Pay the ECN fees and pay the spread and get out of your position. But whenever I can, I want to provide liquidity. When can I? I can almost always provide liquidity when I'm booking profit. Almost always I can provide liquidity when I'm trying to book profit. And most of the time, I can provide liquidity on my entries as well. Not always. If you're taking a very specific momentum trade, you sometimes have to take liquidity. Or sometimes what I'll do is I'll take liquidity on a feeler and then I'll bid in for heavier. I do that a lot. I just take liquidity for a little bit to make sure I'm involved in it. I can't repeat that one out loud, Gilbert. So sometimes I'll take just a little bit of liquidity to make sure I've at least got my filler, and then I try to bid in for the rest. So for myself, what that turns into is that I end up providing so much liquidity in a given month worth of trading. Obviously, there's individual trades where I pay the exchanges more, or an individual day where I pay the exchanges more than they pay me. But usually, if you average things out at the end of the month, I'm getting paid, and sometimes a decent amount. Whatever, an extra $500 on my month is because I provided that much liquidity, and that whatever adds up a little bit, some beer money. So knowing how to route is really important. Knowing where to route to is really important. I think most of us pay for depth in NASDAQ, and NASDAQ gives one of the better rebates. So it's a good one for providing liquidity. Edge A is usually a pretty good one for taking liquidity, but Edge A's gotten a little bit more expensive. Yeah, I guess that covers it. Thanks for the question. From Sebastian on YouTube, what do you think of buying the inside 5 break at 1440 on the SPY? At 1440, it's okay. For a bounce to the 15-minute ADMA. Okay. It looked really good to me because the IWM was making a higher low. Okay. So yeah, I mean, just looking at the 5-minute chart, I'm like, you know, I don't love it. I don't hate it. I see your trade, but you know, you're buying a very weak market at that point. That's kind of, you know, coming. Well, actually, 394. You're still above our major market support. So the more I think about it, the more I like it. I don't love this 5-minute chart. I don't love that you don't have more extension on the 5-minute chart. I do like that you're buying it right above the daily chart support that you want to see hold, and that it's after a big sell-off. I think the time of the day could be a little bit later, might make it better. But there's a bunch of things I like, and then especially if you're having the 15-minute as a profit target for a snapback to the 15-minute 80 EMA or potentially even 21 EMA, that makes it a much better trade. So I wouldn't call it like an A+ trade, but I think it's okay. Again, don't like the 5-minute, but I like the spot on the daily. So hope that helps. From Rex, I tried to go long some Roblox at 9:55 today. Yeah, Roblox looked great at one point today. I like your trade. When it came back to $42 with the ADMA, would you say that wasn't a great trade? No, I like this trade. The market ruined it. Looks like Roblox turned weaker compared to the Qs, as the Qs are making a new high and Roblox was not. Okay, I guess that's a little bit notable, but Roblox had such a big momentum move off the open, and you're above 42, which we know is a key spot on the daily. I like your trade, Rex. I think that the market ended up ruining it more than anything else. Michael asking, is there a list of fees for ECNs? Somewhere you can probably Google search it. The problem with it, Michael, is that it always changes. These ECNs change their costs and what they provide like regularly. So you know, you could look it up right now today and you know, figure out what the numbers are and try to figure out the most efficient way for routing, and then a month later a bunch of the exchanges decide to change things because they do it fairly often, and what you did a month ago doesn't work anymore. I mean, there's some things that tend to be consistent. The Qs and ARCA tend to always seem like they're given higher rebates. New York Stock Exchange is always lower. Edge A is always lower. Generally, the ones that pay, generally the ones that give the lower rebates are also cheaper to take liquidity. Generally, the ones that typically have higher rebates are also the most expensive to provide liquidity. To take liquidity, which makes sense. So usually, you know, if you're really routing efficiently, you don't want to be using the same ECN for liquidity providing as you're using for liquidity taking. So again, as a general rule, NASDAQ is a good one for us to provide liquidity. They're usually higher, but I also like it because everyone who's a pro trader for T3 Trading Group is required to pay for depth for NASDAQ. I like being able to see my own bids and offers in my level 2, so that's like kind of an added benefit. I used to use ARCA, and I paid for ARCA forever, and finally I was like, I don't know why I'm paying for ARCA, and I dropped it, and I switched my main routing over to NASDAQ because it was paying the same amount as ARCA was, and I could see depth. Yeah, so that's generally a good idea, but like I said, it's something that's kind of in flux. All right. Anybody else have anything else? I need a nap. today was a day. Really curious to see how tomorrow plays out. And tomorrow's going to be a wild one too. Friday feels like it's been a long week. We got non-farm payrolls tomorrow. This market's going to be moving again tomorrow. I'm really curious to see how we gap before non-farm payrolls tomorrow, and then what the number actually does to this market and how we come in. I was expecting a big move tomorrow, Nick. One of the questions that's in my mind, though, is if there's a possibility that today's move takes away some of tomorrow's, which Pat seems to think that the answer to that is probably still no. Pat seems to think that, you know, today's sell-off, plus if you got a hot non-farm payrolls that sells us off, might actually mute Tuesday's move from original expectations. But we got to get through tomorrow to even begin to think about Tuesday. But I like Pat's thought process there. All right, gang. Let's call it. Have a wonderful night, everybody. I hope everyone was able to stay safe with this market today, or you know, take advantage of it. Have a great night. See you all tomorrow.